Welcome, I'm Mark Todd from the NAB, and today I'm joined by Nick Yaxley from BondAdviser to discuss the hybrid market, what's been happening in that market and some of the volatility in that market. We also want to talk about, if you're a seasoned investor, how to look at it, and if you're new to the market, maybe perhaps some ideas on how to build out an investment portfolio of hybrids. Nick, welcome. How are you?
I'm very good, thank you. How are you?
I'm good. Before we talk about that hybrid market, let's talk about BondAdviser.
Yep.
You're a research house. Help people understand the role you play.
Yeah, so we're a research and advisory business. So we can focus entirely on debt and hybrid markets in Australia. A lot of our clients include sort of stockbrokers, financial advisors, individuals, and we sort of service a broad set of service requirements for that sort of industry.
Great. The hybrid market, like all markets, have been volatile at the start of the year.
Yep.
Can you give the viewers who are watching this a sense of what's been happening?
Yeah, so there's definitely been some volatility in the market, not so much as the equity market, but naturally you would expect that there has been some volatility. We've sort of noticed it as a bit of a buying opportunity over the last few weeks, and a lot of people have sort of had a lot of incoming calls and questioning about why has it been a bit volatile and why not, and why it's a good time to get into.
Okay, so why is it a good time to get into it, and what sort of returns are people trying to achieve?
Our sort of theory is that fundamentally a lot of the risks haven't changed from a year ago. Now, prices have changed, valuation has changed, but the fundamental risks behind it have actually, if anything, are probably looking better into the future. The basis of the Royal Commission and some of the risks that are designed to come out of the market over the next few years will probably be a good thing for the broader market.
Help people understand the risks. I take it when you talk risks, it's the likelihood of the issuer. Let's say we keep this conversation around the four majors.
Yep.
It's the likelihood of that issuer not being able to redeem at the first available opportunity.
Yes.
What are the other risks?
So with hybrid securities, there's a number of sort of structural features which you need to take into account when you're looking at these things. They're not plain vanilla products. They're things that you need to look at individual features like call options. There's convertibility. There's things called non-viability triggers in these things as well. They're actually quite complex things. You actually need to actually look into it and read about these things. But what they are is they're very much a long tail risk, which means it's a fairly unlikely scenario that something like that will happen, but it is a possibility, so you need to understand them.
So what sort of returns are people looking to achieve? Because I think it's part of that story around the risk return. So the risk is X and the return is Y. If I'm only making, let's say, 4% on my hybrid portfolio, it might not be worth the returns. It might not be worth taking the time. How has the market changed? What sort of returns are they now getting?
Yeah, so at the moment, you've actually had a couple of things working in the favour of the hybrid investors. There's the base rate, or the BBSW rate's been slowly drifting up for a number of reasons. We've also got what they call the premium, or the spread over that, which has been drifting up in the last few months as well. And now you're sort of looking at a yield of sort of 5.5% to 6% on average for the broader market that you can look at to get involved in these sorts of instruments.
I've been following the hybrid market for a while, and one of the things that perplexes me is the fact that when I talk about credit, so let's say it's NAB credit, you don't necessarily get paid a lot for investing longer, which is a normal yield curve. If I invest for 5 years, I should expect a higher return than if I invested for 2 years. Mm-hmm. It seems to be the hybrid market is not offering that right now. You're getting the same return within a few basis points, 20, 30 basis points, regardless of the duration. That doesn't really make a lot of sense.
No, it doesn't. And the way individuals should look at this sort of thing is Impo units of risk. So if it's 1 year till maturity, that's sort of 1 unit. 2 years is 2 units. 3 years is 3 units. That's the sort of basic way that you should look at it. If you're getting paid the same amount for 1 year as you are for 5 years, then why wouldn't you take 1 year? It would make no sense to go ahead on taking more risk for the same return.
Great. 2018, what are your expectations on that hybrid space at the moment in terms of things like new issuance? Do you see much in the way of issuance, or is it rolls? And in terms of volatility, what are your expectations around the equity-driven vol?
Our expectation from the supply side of things, which does have an impact on performance, is that this year won't be a huge year for issuance, especially we'll see some late into the year, but the reason we say that is probably because there's more opportunity for the banks to issue offshore at the moment, so they don't necessarily need to come to the Australian market.
Nick, that was fascinating. I think the hybrid market is one of those things we need to engage a lot more with the customers because it's such a big market, and I want to thank you for taking the time to come and talk to us, and hopefully we'll be able to do this on a regular basis.
Yep.
That'd be great. Look, that was Nick Yaxley from BondAdviser. I'm Mark Todd from the NAB. If you'd like any further information on hybrids, you can look for BondAdviser research. You could also look in our Insights segment on NAB Trade on Hybrids 101. You can also reach out to your NAB Trade representative or your NAB representative. I hope you've enjoyed this video. We'll talk to you soon.